We are looking at problem number 21 in the textbook. This is the Lindscomb family, and they had the following income. Let's see, so Mark earned $63,500, and Ashley, she earned $57,900. That's they made in earnings. They had some interest on investments, so they had some interest. And they had something called IBM, that's a company, IBM bonds. And they made $4,750 in interest from the IBM bonds. Then they had New York City bonds. Now, this could be, in this particular problem, it's New York City. Well, this could be Boston, it could be Miami, it could be Chicago, it could be any of the city bonds that you have. What they do is these are New York City bonds, and by having New York City bonds, they are tax deferred, and we'll talk about it, tax free. We'll talk about that in just a moment. And then we have a savings account interest of $2,600. So the family made mortgage payments that included $16,480, and they paid real estate property tax. This is for taxes for the property of $4,320. They also paid a state income tax. This is state tax of $5,860. And then they also donated $1,250 to a charity. They have 3 kids. Well, so now here's the problem that we have in front of us. It says calculate the family's federal taxable income, and then was their tax liability, assuming they filed jointly as a married couple, and then what are their average and marginal tax rates. So this is a 3 or 4 part problem, so we're going to get started on this. So the first thing we want to do is we want to calculate what they've earned for income. Now, the salaries combined, what I just did was I added them together. It was $121,400. That was their 2 salaries. That was Mark and Ashley. So I'm just going to say Mark and Ashley. So they have an interest of $7,350. Okay, $7,350. So now this is everything except the New York City bonds. So it was the IBM bonds of $4,750 and the savings of $2,600. So if you added those together, it was $7,350. Now, because we're going to treat the bonds differently than regular interest. So what you need to do is this is what they earned $128,750 in just general income. Now, we have to look at their itemized deductions. So in the textbook, they talk about itemized deductions. So we have something called the mortgage interest. Okay, so just as you are doing the problem, just write this right out. So you put the mortgage interest right in there. Then you have some local tax. And then you have property. So you have local property tax of $4,320. And then you also have some state income tax of $5,860. And then you have charitable contributions. Now all this is tax deductible. So what you do is you write all these down. So here's what we've got the ones in the problems. We have a mortgage interest of $16,480 as given in the problem, $4,320 for local property tax, $5,860 for state income tax, and $1,250 for charitable deductions. Well, what we do is we add these up, $27,910. Now we know they also have how many kids? It is 3 kids in the 2 of them, so there's 5 people for itemized deductions. So for dependency, as they call it, that's a dependency, it is 5 times $3,650, and that is $18,250 for what we call the exemptions for the 5 people. So let's go back through this one more time. We added their salaries. We took the interest from everything but the bond, from the city bond, which it could be a New York City, a Boston, a Miami, whatnot. So we added these together at 128,750, these two numbers. Then we said, all right, what is their total deductions? And this was given in the problems: mortgage, local tax property, state income tax, charitable contributions of $1,250, for a total of $27,910. And on top of that, they have something called the dependency exemption. So it's 5 people. It's 3 kids plus themselves, and each one's valued at $36.50. Now that would be in the textbook. So the taxable income would look like this. It would be, we're going to take our taxable income, and the taxable income is going to be the income less deductions and exemptions. So we have income. So if I can bring this down to the camera here, income of $128,750. Then we had these deductions, which we just calculated, of, and I'm putting in parentheses here, 27,910. And then we had exemptions. Now that was because they had 5 people in their family, of 18,250. Now remember, in parentheses we subtract. So now our taxable income would be $82,590. So now what we need to do is, this is our number. We need to now apply the tax bracket for this family. So now they are in the tax bracket of, let me just get to the page here in our textbook. They are in the married filing jointly. So the married filing jointly looks like this. It has 0 to 17,400 is 10%. 17,400 to 70,000 is 15%. 70,700 to 142.70. Now they are falling into they're at $82,590. So they are at $82,590. So we know that according to our textbook, 0 to 17,400 is at 10%. We know that 17,400 to 70,700 is at 15%. And then we also know that anything from 70,700 to 142,700 is at 25%. So in this particular problem, we are going to use the 2012 tax schedule. So basically what you're going to do is, we know that, as we've done this before in different problems, is that they are going to pay $1,740 in this category. So it's 10 cents, 10% times that. So then the next category that we need to calculate out is, we are going to take the $70,700 and we are going to subtract the 17,400. What gives us, in this particular category, we are going to be taxed, we have at 53,300 times 15%. So we're taxed 53,300 times 15%, which would be $26,650 for that particular category. So then, in this category here, we know that we are following here. It was 8250, so 82,590 minus 70,700, and then what you're going to do is you're going to calculate that out, and I'm just using my calculator here to make it easy. And it looks to be, in this particular category, $11,890 times 0.25. So you see what I did was, I started off with the top where they are times the bottom edge of that category and found out how much they've got to do, and now I'm going to multiply that times 0.25 cents for every dollar, which would be $2,972.50. So going back to the notes here, we are going to add 1,740 plus 26,650 plus 2972.50. And once we get those going, then what we are going to do is we are going to come up with or calculate out what our number looks like. So let me just do this here. So $1,740 I'm going to add in. So I'm going to just double check this number of 53,300 times, I'm just double checking it, times 15 cents. And my number is wrong, and I apologize. It just didn't look right. It's $79.95. Let me do that one more time. It's 53,300 times 0.15. Yeah, $79.95. That's the taxable number. I apologize. So what we're going to do is I'm going to change it down here. 79. This is why I always double check. And plus, so I'm going to add that to the memory, and then we're going to add 2973. I'm just going to round up. And so we have a taxable income of $12,708. That is our taxable. That's the tax that we're going to pay based upon the taxable income of $82,590. So this is the tax that we're going to pay. So then the question that they're asking in this particular problem is they would like to know what is our average tax rate, and then what is our marginal tax rate. Well, the marginal tax rate happens to be the last tax category. So if you check out this in the textbook, it's 25%. So marginal tax is 25%. Then the average tax, well, here's what we also need to do, is that we take this number and we add it. We go like this. We say $12,708, and we divide it by this number right here, the 82,590. And then when we do that, let's calculate that out. 12,708 divided by 82,590 gives us 15.4% average tax rate. Okay, so that would be the end of the problem. If you have any questions, please feel free to reference the textbook.